Nolan, good to see you. A really timely conversation. How to invest when interest rates are cut. Interest rates have been high since March of 2022, but they are finally coming down. That means it is time to rethink how we are investing. But first, can you explain why now the Fed is lowering rates?
Sure thing. What the Fed does with interest rates really is what they're trying to do is control the velocity of money or the speed of money, and the rate at which we can really access it. So what we show you in this chart is why the Fed started raising rates in the first place. And the colored lines are inflation metrics. You see CPI, core
Right.
CPI, PCE. These are all different variations of essentially the same measurement. What is inflation? So you see inflation start to escalate quite a lot. It starts to peak out, mid-year 2022. And that's really when the Fed started getting aggressive with their
Yeah.
interest rate raises, ending about a year after that, mid-year 2023. So now the Fed deciding to decrease interest rates, they've decided, well, now that inflation has come back down to a reasonable level, we can start to decrease these interest rates, allow money to maybe flow a little bit more freely in the economy because we are not as heavy of an inflationary risk anymore.
Of course, when the Fed was raising rates, everyone was concerned about a recession. So when do we know if we have successfully avoided a recession?
Unfortunately, there's not a very clear-cut answer, but there's a board of economists basically that look back over certain segments of GDP growth or decline, economic growth or decline, and they usually won't coin something as a recession until maybe about 6 or 9 months after the recession actually happens. So officially, we won't know for many, many months. But I think if we all see maybe the stock market start to tumble, inflation pressures continue to remain persistent, and then maybe interest rates don't decline as quickly as possible, we may be in a situation that could come to a head a little bit and cause recessionary pressures, even if it's not called a recession,
hmm
similar to what we dealt with in 2022 or even during the pandemic in 2020.
hmm So let's talk about investing when interest rates are on the decline. What is the biggest difference?
The biggest difference when interest rates are being cut is where you are focusing putting your money. A lot of folks, when interest rates are quite high, they're comfortable putting money in the bank or putting money in bonds or fixed income. It's good investments. However, when interest rates go down, those investments become a little bit less attractive. So we can talk about a few specifics in just a moment, but there's quite a bit of a difference as far as where you should go maybe to try and get your expected rate of return. It's not as
hmm
easy to get 6% anymore.
I know, I'm going to miss that. Okay, let's hop into the specific investments that you recommend in a lower interest rate environment. High yield investments, bond ETFs, preferred stock, REITs, real estate investment trusts, and housing stocks. Why are these better investments now?
Thanks. Thanks for going through all those. High yield investments, the first one, I really like those because high yield investments, those are more like corporate bonds or maybe slightly lower rated bonds than government bonds. The rates on those typically remain a little bit higher, even as the Fed is lowering rates. So you can still go find some high yield investments, some individual bonds that are still paying a very attractive coupon rate or very attractive interest rate. The bond ETFs, those are maybe a play in a declining interest rate environment because if you were to purchase bonds right now and rates go down, the bonds you purchase today may be worth a little bit more. So if you plan on maybe trading the bonds, you could take advantage of a declining interest rate environment as maybe propping up the value of the bonds you buy today. So that
hmm
could be one strategy.
hmm
And then maybe the last one I'll go through is like housing stocks or like commercial housing stocks. A lot of people will look to real estate in particular, but will go to the stock market for that. I think that housing stocks are good, but when you are investing in housing stocks for interest rate purposes, you're trying to take advantage of people having access to mortgages and lending a little bit easier. So when you're doing housing stocks, you want new developments or maybe commercial buildings or things like that that are going to be I don't know, maybe have a very good bump if interest rates decline, as opposed to some of the more traditional real estate investments.
Right.
So just some suggestions and thoughts, and every situation is different. So not everything is good for everyone.
Right. Definitely a good time to think about pivoting, though, with some of our investments. Nolan, if somebody would like to speak through any of these specifics, how can they get a hold of you?
So they could call us at 616-301-2581 or go to our website, which is cornerstone-rp.com. And there's a contact us box at the bottom of the page.
Great. Nolan, thank you.
Thanks, Erin.